Finally, we are moving on from Fibonacci. In this lesson, we're going to be looking at market conditions. The learning objectives in this lesson are: you should know the types of market conditions, and you should know the difference between corrections and reversals. Knowing what the current market conditions are can help you choose an appropriate strategy for the current market. For example, you would use a trend-based strategy in a trending market or a range-bound strategy in a ranging market. Some indicators work better in certain markets. For instance, Fibonacci levels and trend lines are useful in trending markets, while pivot points, support and resistance levels are helpful when the market is ranging. There are two types of market conditions: trending and ranging. In a trending market, price is clearly moving in one particular direction. Price is moving either up or down. In an uptrend, price makes higher highs and higher lows. In a downtrend, price makes lower highs and lower lows. It is best to trade in the direction of the trend because there is a higher probability of the trade being profitable. In trending markets, you should use leading indicators to try and enter at the start of new trends. Next, we'll be looking at ranging markets. This is also referred to as a sideways market. Price is moving within a range, and there is no clear sustained uptrend or downtrend. There is a support and resistance area, and price bounces off these two levels. This is a real-world example here. Often, these areas of support and resistance are tested 3 times, validating them. The upper and lower levels may not always be exact or clear to observe. However, what you will see is the price rising and falling within a maximum and minimum price zone, like you have here. I would say don't focus on the wicks and only the bodies, because then you would get a clearer level of what the resistance and the support level is. In ranging markets, you should use oscillating indicators because knowing when price is overbought or oversold will indicate whether to either buy or sell. You should also look at volume because during trends, volume often increases, and during ranging markets, or when the market is ranging, there is low volume and it stays quite level. It could fluctuate, but it usually just stays quite level. And then when it goes back into a trend, volume increases again. Next, we'll look at corrections and reversals. There is a distinct difference between a correction and a reversal, and it is important to differentiate between the two. A correction, sometimes referred to as a retracement, is when the market moves in the direction of the trend, and it pulls back for a short time and then continues on in the original direction. Whereas a reversal is when the market direction changes completely and goes in the opposite direction to the trend. In summary, there are two types of market conditions: trending and ranging. An uptrend can be identified as a series of higher highs and higher lows. A downtrend can be identified as a series of lower highs and lower lows. Ranging is when price is trading between an upper and lower boundary. And a correction is when the market pulls back but continues on in the trend direction. And a reversal is when price completely reverses in the opposite direction of the trend.